Alright, hey guys, so today we're going to talk about the stock market, whether the recession will truly come and will the bear market that everyone has been anticipating arrive in 2023. Okay, so if you're invested in the market, you want to watch this. Now, let me just give a quick disclaimer. None of what I'm just going to say here is financial investment advice, but really is to share my perspective, right? To educate, be you're a seasoned investor or you're a new investor out there, how do I look at the market? And maybe it'll benefit you as well, okay? So the most important question right now that many people are asking is like this picture, right? Is where is the bear market that people have been anticipating, okay? And this has been something that everyone has been talking about, right? I would say even start of 2021, okay? And they say, no, Pete, this year there'll be a recession, there'll be a bear market. Okay, so before we go into recession and bear market, when is it coming? Let's just drive in the definition first, right? Which is very important. And here's the definition actually from the official source, right? From the US. And it says it will be 2 consecutive quarters of falling real GDP, okay? Now, although they say this is not an official definition or the way the economists state it, but it is actually a criteria when one of the US entity, right, will qualify that this is a recession. Now, the thing is this is kind of like, you are looking backwards because I don't know how many of you all have this experience where, you had children, okay? So when your wife tells you that you're pregnant, very likely it's because they bought a pregnancy kit, right? And you're seeing 2 lines, right, on the pregnancy test kit. Now, by the time you see the 2 lines, you're definitely pregnant and it's a bit too late to do anything else, right? So the same for recession over here. By the time you see 2 consecutive quarters of falling recession, guess what? The recession already took place during the 2 quarters and you might be over it already, okay? So that's one key thing that I think many people are looking at right now. And another very strong indicator is actually the yield curve inversion. Now, for those of you who don't know what yield curve inversion means, it's actually taking the longer duration treasuries in US, like the 10-year, minus away the 2-year treasuries. And usually what you will get is that it's a positive number because the 10-year treasury usually gives you higher yield. And when this yield difference inverts into negative, right, historically they use it as this is when you will see a recession happen, right? And it has been quite accurate in the past, to be very honest, okay? But however, this year we are seeing a yield curve inversion that is way steeper than what we had even during COVID, right? And we are not seeing the recession right now. I think one of the main reasons here, and this is me just giving my perspective, right, is that the Federal Reserve really has successfully tamed the inflation without causing a recession. And this is what many people call the soft landing, okay? Right? And why are we still seeing the inversion? Because the long end of the yield curve, which is the 10-year treasury and the 20-year treasury, are still low. It's not really because it is predicting recession, right? My guess is that because, guess what? With lower inflation into the future, your treasury yield will be lower for your 10-year and 20-year as well. So the inversion in this case is actually telling you a good news that we are going to have lower inflation without a recession. Another thing that kind of moves the market a lot right now, right, is this whole anticipation of the crash of the housing bubble. In fact, you can see over here, there are many articles including Bloomberg, Market Insider, and Forbes earlier part of this year saying that the US housing market is going to crash. And it's not just major news, but also famous people such as Elon Musk saying that this is the most serious issue looming. But if you listen to all this sentiment talk, right, and people who have no business being in the property market talking about property being a very serious bubble, you would have missed out one of the best opportunity to buy US market because the US home prices, after it has dipped a little bit from June 2022, right now it is starting to recover, okay? In fact, this might be the shortest bear market in the US housing we have ever seen. Now, why is this the case? And that is because one of the main reasons is that the US, they are not like Singapore or many parts of the world where you can only fix your rate for maybe a 2-year to even 3-year or 5-year. In the US, you can fix your rate up to 30 years. Yes, so even if, right, the interest rate has gone up in the past, right over here, you can see, right, guess what? It's going to affect you. Let's say you got a good rate, right, back in 2015 or even 2020. You just don't need to adjust your rates, Okay, so long you don't sell your house, you don't have to remortgage or refinance, you are still stuck with the low rates at about maybe 2-3% versus right now it is closer to 5-6%. Okay, so housing rates increasing, interest rate increasing actually doesn't affect all the homeowners in the US. In fact, if anything, it pushes them to not sell their house, causing what we are seeing right now, the total housing inventory dropping to some people call a 40-year low, right? And because most people right now, if they own a place and they already lock in a very low rate, guess what? They're just going to say that, hey, I'm not selling my place, okay? They are not going to sell their place at all. And this kind of drives the US housing market. Yes, we had a little dip previously, but right now we are seeing a very nice recovery again, simply because the supply is short. And this is something that we are also seeing in Singapore, that the supply is really short. And on top of that, not just, we don't have the 30-year fixed rate. So a lot of people thought that we might have a housing crisis where people are forced to sell their house. But if you look at recently what the Monetary Authority of Singapore pushed out, right, in November 2022, one graph that was very important is this, right? It is the credit quality of housing loan, and they call it housing NPL. Now, NPL here stands for non-performing loans. Now, non-performing loans, what does it mean? When they say non-performing, it's not that you're not dancing in front of them, but it just means that it is very likely you will not be able to pay off this loan based on how many times you have defaulted on the mortgage payment already. And where are we right now? Yes, there's a little spike during the COVID season where we went up to about 0.5%, but this number has never truly gone above 1%. In fact, right now, we are at 0.3%. Okay? And on top of that, you can also see the loan to value ratio. That means how much people are borrowing versus the price of the house has been dropping. Okay, so right now, really, there's a very small number of Singapore housing loan that is non-performing. And you might ask why? Why hasn't the higher interest rate pushed people to, defaulting on their mortgage loan and not paying? Why is that the case? And that is because of the policy in Singapore, which we call it the TDSR, right? Where you are only allowed to use a certain percentage, in this case 55% of your housing income, right, your own income, to pay for the housing. Okay, and this is even more stringent when it comes to public housing, where what we call the MSR, mortgage servicing ratio, is only 30%. Now, I don't want to turn this into a property session, but why I'm showing you this is because even if, right, the narrative people had was that the housing market is going to pull down the stock market, what we are seeing right now is just not happening, because both in the US and even in Singapore, and I think many parts of the world as well, many of the homeowners are what we call diamond hands. They are just not being forced to sell. They are in a situation that you cannot force them to sell. And what happens is you actually lower the inventory of stock housing that people can buy right now in the market, should they choose so. And guess what? That actually drives up the price. So therefore, the whole narrative of housing market crashing the stock market also doesn't really hold water in this case, right? So please take note when you are following any of such news outlet. Just be very mindful, do your bit of research, and try to understand the issue a bit better. Now, going forward, what's going to happen? Okay, so this week we have a very interesting week. Both, not just both, but the Federal Reserve, the ECB, and the Bank of Japan are going to announce their latest interest rate policy. Okay, and over here you can see the article talks about it being a pivotal point. Why? Because it is a pivot point, right? The Federal Reserve said that they are going to raise perhaps another 2 more rate hikes of 25 basis points each. Okay, Bank of Japan has not raised rate at all, and ECB is also thinking about lowering interest rates, seeing that the inflation numbers is coming down. So the question is, if you think that the stock market right now is at a very high level, should any of these big banks, especially the Federal Reserve, starts to keep the rate steady or even lower the rates, then the question is, where do you think the S&P 500 will go? Okay, now over here, I'm not going to say that I have a crystal ball, right? But I'm still relatively bullish, because I do think that the Federal Reserve are a sensible bunch of people. They are not going to crack the economy. Now that we have started to see inflation numbers coming down, I think there's a very good chance that the Federal Reserve will also start to ease out, right? the rate hikes. And on top of that is that overall, I think the economy is doing very well, is very strong, and that's because of the earnings of the S&P 500 company. Okay, so this actually tells you the percentage of companies that announced their earnings in the past that was surprised. That means it is higher than consensus, higher than expectations. And you can see when we have a higher number of companies not giving a surprise, not surpassing expectations. For example, here in the 08 and also most recently during the COVID season, what we see is that the market starts to trend down. And where are we right now? We are actually at a very healthy average level, right? That only about close to 18 to 19% of the companies did not surprise consensus. And on top of that, even those that did not surprise consensus, guess what? They also contribute to this chart over here, which is the overall operating earnings of all these companies put together, and they divide it by per share, right? So this is basically the whole S&P 500 as a market, right? The earnings per share. And you can see this earnings per share is also a very strong relationship with crisis. So whenever we had a drop in earnings, right, then we will be in a crisis period. And yes, we had that during COVID, but right now, really, we are just seeing a little bit of dip, and right now we are increasing back up again. So it really makes it really hard for people who are believing that the bear market is going to return. Okay, now talking about the Federal Reserve, right now everyone is anticipating, what will Jerome Powell do? Will he hike another 25 basis point, or should he hold? And I just want to share that should he hold the rates, okay, and not increase it further, I think that's going to be an excellent news for the stock market. Why? Because if you look at the stock market, you can see that in the past, we do have periods of very high rates as well, but the stock market, right, subsequently continues to climb as well, right? So I don't think high interest rate is the problem here. In fact, if you look at correlations between high interest rate and the stock market performance, there isn't a very strong correlation. But if anything, fluctuating rates is the one that have trouble with the market because the economy is unable to adapt, right, with the rates continuously fluctuating. All right, okay, so that's all I want to share in this video right here. I hope you find this useful. Let me know in any comments, and if you like this type of stock market video on top of my property videos, do let me know. All right, do like and subscribe, and I'll see you guys next time.